For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
You have suffered financial loss while investing, and you think your bank, broker, fund management company, unit trust management company, PRS provider or distributor, or their agent or representative is responsible. You need help sorting out the problem or want to seek redress. Where do you go? Sidrek is here to help you start the conversation and reach some resolution. First, lodge a formal complaint with a company that sold or offered you the unit trusts, shares, derivatives, or other capital market product or service. But you're not happy with their response. You have 180 days from their final written reply to come to Sidrek. Or if there's no written response, and it's been 90 days since you wrote to them, you don't need to wait longer. You may come to Sidrek even though you haven't received a final response yet. Sidrek first checks the eligibility of your claim. For example, is it within Sidrek's claim limit? Is it against a member of Sidrek? And so forth. If your case is eligible, we begin the dispute resolution process. All information in this process is confidential. We get both you and the member you're complaining against to sit with us and have a conversation. Documents and information will be required from both parties. No lawyers are allowed in the mediation process, as we keep the discussions informal and private. Our mediators are impartial and will hear both sides out and help parties communicate constructively towards resolving the dispute. 2 outcomes are possible at this stage. Either both you and the member agree to a settlement, or you don't. If the both of you agree to a settlement, an agreement is signed and the mediation process ends successfully. But if both you and the member fail to reach a satisfactory resolution, mediation has thus failed. But don't worry, Sidrek then proceeds to the next stage, adjudication. During adjudication, parties are given the chance to provide any further information to help their case and ask each other further questions. Our adjudicator will then study and consider all facts and information provided, including the conduct of the parties, laws, and best industry practices, as well as what's fair and reasonable. Sidrek's adjudicator will then make a final decision on the dispute and the monetary claim. If the decision is in your favor, it could be a full award or a partial award for your claim. But if the decision isn't in your favor, then no award will be made. You, the investor, will still have a choice. If you reject the decision, Sidrek will simply close the case and you may seek other legal avenues for redress. If you choose to accept the decision, however, the member has to comply with it. Once the parties have confirmed compliance to the decision, Sidrek will close the case. So let Sidrek help start the conversation towards resolution. For more information, visit sidrek.com.my or call 03 2282 2280.
Bursa Malaysia has been part of the Malaysian economic growth for over 4 decades. We have been working relentlessly to create a transparent, efficient, and vibrant stock exchange.
While we've been working at building a vibrant marketplace, inclusivity and contributing towards economic growth, we have also channeled efforts and resources towards supporting the community at large. Shares to Share is one such effort, which has been developed to create positive impact towards society and the environment. To put it simply, Shares to Share is a transparent and easily accessible facility that enables investors to donate their listed securities or proceeds from the sale of their listed securities towards charity through Yayasan Bursa Malaysia. You can donate odd lots or even board lots. The funds from the sale of these shares will be channeled to approved charitable organisations and their respective initiatives or projects.
Bursa Malaysia has waived its portion of the transfer fee, clearing and trading fees for all transactions that are conducted under Shares to Share. The participating brokers of Shares to Share have also agreed to waive their portion of the transfer fee and brokerage. The charitable organizations that have been selected have undergone the necessary due diligence process and have been duly approved by an independent selection committee.
At least 500,000 populations live with some kind of disabilities. They are most of the time being left behind. We need to empower them, otherwise they will continue to be the liability. A lot of human resources wasted from this group of people.
We provide a lot of support for persons with disability who are young adults and adults. We have a social enterprise called Project I'm Possible, where we managed to hire all persons with learning disability to work here. We have a cafe, bakery, weaving, and we have an art gallery.
Purity of thought, word, and deed, that is action, is very important to be really successful. We must know some skills to be able to help us then paperwork. The grant from Shares to Share will be used for, one is sewing, handicraft, classical dance, and so on.
Our patients have to be fed, they have to be looked after. We look out for any sort of disease they might develop, and also those unforeseen circumstances. Thanks to Bursa's initiative, we can be a little bit easy on our patients if they are family members.
Donations will all be channeled to organizations that are involved in the sustainable development of Malaysia. The Shares to Share scheme offers you the chance to do so in a simple and effective way.
Bursa's Shares to Share allows us to do good by donating our shares to charities. You join us in making a difference to the society by donating your listed shares.
Shares to Share is open to all donors, individual as well as corporates or other types of entities. You can transfer your listed securities via Bursa Anywhere app at a click. For more information, please visit our Bursa Malaysia website.
Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today, our webinar title is 5 Pointers to Know to Become a Better REIT Investor. My name is Shen Chu. I'm the moderator for this session. Now, before we begin, as usual, disclaimer, whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all investment risks. So today, we're going to talk about real estate investment trust. How do we differentiate fundamental good REIT and how do we differentiate, fundamentally weaker REIT. Okay, our speaker today, Ian Tai, is going to share with us his tricks into identifying strong and solid real estate investment trusts, and what do dividend investor like us need to know to become a good REIT investor. All right, so allow me to briefly introduce the speaker profile. He is a content producer on kclau.com. He has written over 250 articles on kclau.com, and he's also the weekly webinar host and presenter. He is the co-founder of dividendvault.com, where he manufactured savvy investors who can build dividend-based portfolios independently. He himself is a dividend investor. He primarily invests for dividend income, and his yields is ranging between 2 to 9% per annum. So, ladies and gentlemen, here we have Mr. Ian Tai with us today. So, Ian, how are you today?
Hey, really good. Hello, Shane. Hello,
All right,
everyone.
good to see you. Good to see you.
So good to see all of you here.
All right, so I'll stop sharing my screen and hand over control to you.
All right, sure. All right, once again, my pleasure to be here at the Bursa event, especially organized by your company, LifeChamp. So for today, we are going to talk about REITs, and I've prepared a lot of materials for you guys. So let me just quickly share with you my screen, so that all of you guys are actually looking at my screen. And just a few tips before I start this webinar session. The first one is that if you have a mobile phone right beside you, please stand by that, because we're going to do some simple calculation. All right, because one of the things that we're going to do is that we are going to calculate the net dividend yield or the net distribution yield of a REIT. Okay, so I'm going to do a demo. So please do stand by the calculator mode. Okay, the calculator function. Number two is that if you wish to interact with us, please use the chat box. And finally, if you have any questions, feel free to just post them in the Q&A box. Okay, I will love to actually address most of your questions being posted in the Q&A box right after this session. Okay, so with that, let's start the webinar. So this will be the syllabus for today. There are 5 things that I will be covering in this webinar session. Number 1, the criteria to select REITs that are fundamentally solid. Okay, so it's just like what Shane has mentioned. There are REITs that are fundamentally solid, and there are REITs that are fundamentally weak. So the solid ones are our focus. The weak ones, of course, we just dismiss them. Okay, so that's the first one. Now the second one is actually something which is more current. The current issues that REIT investors may be facing, which is interest rate hikes. So today I will actually gear in my focus when it comes to this webinar session on interest rate hikes. So the thing is that I'll be answering which are the REITs that are more impacted, okay, and how do we actually look at them. So that's the second one. The third one is also related to interest rate hikes, whereby we're going to talk about gearing ratio. Okay, gearing means debt. So the question is this: how does a REIT actually grow its portfolio? And the answer is actually right on the screen, which is leverage. But as to how that is actually, and what is the mechanism that the REIT uses, of course it's that, but how does it work? So what happened is that in this webinar session, I will illustrate how that can happen for a REIT. And the fourth one is actually the reason why I requested all of you guys to stand by the calculator function, because we're going to calculate the net distribution per unit of a REIT. And last but not least, very important, no matter how good the REIT is, there are always, it is actually very important for us to value a REIT before we invest. So therefore, I will introduce to you 2 key metrics to assess the valuation of a REIT. And more importantly, I will address the art behind using these 2 key metrics. Okay, so these are the 5 things that I will cover in this webinar session. Now, part number 1 is a place where I'm going to talk about the first 2 questions. The first 2 things that we are going to cover in this webinar, which is the criteria to select REITs that are fundamentally solid, and number 2, the interest rate hikes. Okay, so with that, let's get into it. So basically, all in all, in Malaysia, I mean to say the REIT market is not exactly super big. So if you want a summarized version on what are the things that we will be looking at when it comes to REIT, so that we can filter the good ones from the bad ones, basically there are 3 main criteria. Okay, and they are all interrelated. So the first one is actually occupancy rate. So which means to say we want our properties, we want a REIT whereby the portfolio, the portfolio of real estate that they have, right, they are always in demand by their tenants. And if they are in demand by their tenants, obviously their occupancy rate will be high. And if let's say these REITs have properties that are high in demand by their tenants, obviously they're going to have better rental income. And because of that, this will actually help to actually satisfy criteria number 2, which is actually the income productivity of the REIT. All right. So high occupancy rate will lead to very good, very strong income productivity of a REIT. And naturally, of course, it will also impact the balance sheet of the REIT. Okay, simply because balance sheet is actually, it comprises of a few things. Number 1 is the asset, especially asset lah. All right, because asset valuation, which is property valuation, is also quite dependent on the income productivity of these properties. All right, high rental income means high valuation. So it's actually as simple as that. All right, so it's just like our very own physical properties. If we can actually fetch higher rental for our properties, naturally, of course, over time, our physical properties will also reflect that kind of rental rate in terms of our property valuation. So all these 3 is actually quite interrelated. All right. Now let's take a look at each and every single one of these criteria in greater depth. So let's look at occupancy rate. So typically, what we are looking at is actually the overall portfolio. Simply means, what do you mean by overall portfolio? Overall portfolio simply means that, let's say, for example, a REIT has 10 properties. So 10 means what we are looking at is the overall, means the overall 10, the performance of the 10 properties. So if the overall portfolio of the REIT, the occupancy rate is actually more than 95% consistently every single year, this will actually indicate that the properties in the REIT portfolio are commanding high demand from their tenants. So in essence, it actually indicates high rental demand. Okay, so do mark this. You want a REIT whereby the overall portfolio occupancy rate is actually more than 95%. Of course, in Malaysia, there are some other REITs whereby their overall portfolio, their occupancy rate is actually below 90%. There are REITs whereby they are achieving more than 95%. That is actually really good. There are some REITs whereby the occupancy rate in terms of their overall portfolio is actually between 90 to 95. That one, case by case, it can be acceptable, it may not be acceptable, depending on the situation. But the worst one is anything that is below 90%, we can actually dismiss it lah. All right. So if the overall portfolio of the, in terms of the occupancy rate is actually below 90%, that means to say the REIT or the properties that they have struggles to attract tenants. And that is actually the thing that we want to avoid as a REIT investor. Okay. So anything above 90% or 95% is a good thing. Okay. Number 2, now I'm going to talk about financial results. Okay, so commonly speaking, general practice as an investor, what we want to see is that as an investor, when we invest into a stock, it's always for the long term. And in terms of its financial performance, we want to see that the stock or the company or the business continues to deliver consistent growth in sales, profits, and operating cash flow. Okay, so we want it to deliver consistent growth over the long term. But then, of course, for REIT, because we are in the property business, we are actually in the property renting business. So I will actually segregate it into, to be fair, to actually have a much more accurate assessment or much more meaningful assessment of a REIT's financial performance. I will break it down into 3 separate periods. Period number 1 will be a period where it is actually before COVID-19. So this one will actually reflect the true, or more or less the actual ability of the REIT to generate rental income and distributable income to its unit holders. So period number 1 is actually a period representing by normalcy. Means if everything is normal, how does the REIT perform? That's period number 1. Period number 2 is actually during COVID-19. So during COVID-19, which is 2020 and 2021, understandably, some REITs are going to be affected. It depends on what are the properties that they hold, all right? So some properties like if it's retail malls, all right, if the REIT has retail malls, then of course it's going to be impacted. If the REIT is holding on to hotels, then of course it's even more impacted. Of course, there are properties whereby it is actually less impacted, like for example, industrial properties. Then of course, that one is actually less impacted by COVID-19. Okay, so this one actually is quite situational. It depends on the type of properties that the REIT is holding on. Okay, but anyway, period number 2 is actually it refers to what happens during COVID-19 and how resilient is the REIT during this period of time. And the last period will be period number 3, which is right now, post-COVID-19. So now the pandemic has shifted into the endemic phase, and then now it's kind of like more or less back to normal. So typically what we want to see is that did the REIT actually report a recovery, a rebound in terms of its financial results? Okay, so this is actually the 3 different periods that we are going to assess. Now, typically, a good REIT is supposed to actually, when it comes to its profitability, which is commonly known as distributable income, typically it should look something like this. Okay, when it comes to a fundamentally solid REIT, it should look something like this. Period number 1 is a period where everything is normal. So when everything is normal, a REIT should actually deliver consistent growth in distributable income. Okay, so there's a period of growth. That's number 1. Number 2 is when there is a pandemic. Okay, so it's unprecedented. It is actually quite something that has impacted the REIT market. So this one actually is quite understandable. So what happened is that of course we give them a leeway whereby the distributable income kind of like drop in this period number 2. But then after COVID-19, it should actually recover. So therefore, as you can see from these figures over here, which is actually a decline, it should actually recover. So if let's say a REIT in Malaysia can actually deliver such level of distributable income, such level of profitability, then I would say that it is more fundamentally solid. Okay, so typically the pattern looks something like this. Okay, now as you can see over here, this is actually the sample of a stock price of a fundamentally solid REIT in Malaysia. So I won't reveal to you what is actually the REIT, but it is actually listed on Bursa Malaysia. It's denominated in Ringgit Malaysia, and as you can see, the price, or you can say the stock price, should actually remain more or less stable, reflecting on the long-term solid fundamentals of the REIT. Okay, so a very good exercise for REIT investors is to actually keep track of the REIT's past 10 years long-term financial results, and you compare with its long-term stock price performance. All right, the long-term stock price performance should actually reflect its long-term financial results. Okay, so this is actually a hallmark or an example of how a fundamentally solid REIT should actually look like. Now let's look at the example of a fundamentally poor REIT. Now in this case, for a fundamentally poor REIT, what happened is that the distributable income, as you can see, period number 1 is a time where everything is normal. Even when times are normal, right, you can see that the distributable income has actually declined over time. And of course, with COVID-19, it's actually impacted further. And even after the pandemic is over, now shifted to endemic, now back to normal, the distributable income did not recover, but it actually continued to decline. Oh boy. So in this case, if let's say you see a REIT that is generating this kind of financial results, then it is very obvious that this REIT is fundamentally poor. It is actually quite poor in terms of its income productivity. So this is actually a REIT that we should avoid. Okay, not revealing the name of the REIT, the actual identity of the REIT itself. Okay. Now, this is the stock price movement, an example of a fundamentally poor REIT. As you can see, it has nothing to do with COVID-19. It's just bad, poor, weak fundamentals. And you can see that the stock price actually is just a one straight heel down. That's it. Okay. It's kind of like a reflection of its long-term fundamentals, which is poor, which is bad, which is weak. Okay. So now we get to see the two, all right? The good ones that can hold its value, and the bad ones that cannot. Okay. So this is actually how they look like. Now the third one. So just now we actually look at the occupancy rate, and then we look at its financial results, and then we compare it with its stock price movement over the long term. So that's the second one. Now the third one is actually the balance sheet. Okay. Now, when it comes to the balance sheet, there are three things that we are going to look at. So the first one is actually net asset value per unit. The second one is gearing ratio. The third one is fixed or floating rate. Later, I will explain this. Okay, I'll explain this later. So let's look at net asset value per unit. Now, net asset value per unit is actually calculated like this. Number one, we have assets. So in the balance sheet, we have assets of a REIT. We minus off the liabilities of the REIT. From there, we have the equity of the REIT. We take the equity of the REIT, we divide it by the number of units in circulation or units in issue. That's how you get net asset value per unit. So as a REIT investor, what we want is to have a REIT whereby it continues to generate, or it continues to report growth, consistent growth, or at least stable. At least it keeps its net asset value on a stable level, or it continues to grow. What does it mean? If let's say a REIT continues to report either steady or growth or growing in terms of its net asset value per unit, it means that usually then we will actually track its assets. We look at its investment properties. Has it actually appreciated in value? Usually a REIT that can report consistent growth in net asset value per unit tend to have properties that continue to appreciate over the long term, which means to say that is actually a very good sign. Now, usually the lesser case, the not so preferable case is where we find a REIT which reports declining net asset value. Declining net asset value there are two ways to go about it. The first one is actually very undesirable, which is where the REIT itself, the properties that they have, depreciate over time. That is actually not something that is favorable to investors. The second one is they have increased their number of shares or their number of units. So when they do that, then of course the net asset value per unit actually goes down. But this one is more towards on a case-by-case basis. Okay. But if you don't want to actually haggle so much on all this, just remember, just find the ones where the net asset value rising or at boom. Okay. So example is solid REIT. So this is actually from a REIT. Okay, we have actually taken a look at its income productivity just now. So for a REIT, the net asset value per unit actually is something like this. It's kind of like steady. So this one is actually quite okay. And for B REIT, typically for B REIT, which is an example of a fundamentally poor REIT, you have net asset value per unit on the decline. So this is actually not something very good. You want it steady or increasing, you don't want it to decline. Okay, so that's the first one, which is net asset value. Now, the second one, I'm going to just talk about gearing ratio. Okay, so this is actually from Securities Commission, they have actually mostly it's investments plus some cash that they have, and etc. 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 They total up the total asset value times they multiply it with 100%. So there you go. They have that is actually the gearing ratio. So let me give you an example. Let's say, for example, a REIT has 20 million in debt and its total asset value is 100 million. So 20 million divided by 100 million times 100%, and the gearing ratio for that REIT is 20%. So that is how they calculate gearing ratio. So for Securities Commission, for Malaysian REITs, the maximum gearing ratio is set to be 50%. Okay. So last time during pandemic time is actually 60%, but now it's still, but then the actual one before it goes up to 60% is actually 50%. Okay. So we just stick to 50% for now. Now for a good REIT, typically for a REIT, when it comes to gearing ratio, we will prefer a REIT that is of lower gearing than the higher gearing one. So low gearing one will be somewhere below 40%. The high gearing one is actually above 40%. Usually the case for the below 40% one is actually better than the above 40% one. Okay, so do take note of that. You want a REIT to have lower in terms of its gearing ratio. So below 40% is preferred. And last but not least, we are going to look at fixed or floating ratio. Okay, so what does it mean by fixed or floating ratio? So like, for example, our mortgage, okay, our mortgage for a physical property, that's fixed rate, that's floating rate. Okay, so fixed rate means, so like, for example, every now and then, Bank Negara Malaysia will actually announce to the public on the OPR rate, which is the overnight policy rate. So this will actually impact our mortgage rate. So if, let's say, for example, like myself, my mortgage is actually on the floating rate. So the thing is that because my mortgage is on the floating rate, OPR increases, of course, the mortgage rate will increase. So my borrowing cost will be higher. And when my borrowing cost is higher, then of course, the more money I have to pay, the more in terms of monthly installment I have to pay to the bank for my own property. Okay, that's have higher borrowing costs. Higher borrowing costs simply means lower profitability. It's as simple as that. And of course, if let's say Bank Negara decides to reduce the OPR rate, which means the OPR rate falls, interest rates will also fall. Therefore, it will cause the REIT to incur lower borrowing costs and thus higher profitability. Okay, so that is floating. That is debt with floating interest rates. But if let's say the debt is actually based on fixed rates, which means it doesn't matter what the Bank Negara says, it can be high, it can be low, it doesn't matter because it has been fixed at a certain rate beforehand. Okay, so when it comes to interest rate, because a lot of REIT investors are very concerned about interest rates. Oh, interest rate go up, what happened to the REIT? Interest rate go down, what happened to the REIT? Actually, it really depends on the REIT, because usually a REIT has both fixed rate and floating rate in terms of their debt. So the REIT that is more impacted to OPR will be the ones that have higher ratio or higher proportion of their debt in floating rate than fixed. Less impacted by OPR, more fixed rate debt as compared to floating rate debt. Okay, so guys, if you want to have a REIT that is less impacted by the fluctuation in interest rates, you go with the ones that have higher proportion of their debt in fixed rates than the one that has lower proportion of their debt in lower proportion of debt in fixed rates. Yeah. Okay, so that is actually how we look at things. So the thing is that when it comes to interest rate hikes, the ones that are going to be impacted are the ones that are, number one, of higher gearing ratio because they are more debt. Number two, the ones that have more floating rate will be more impacted. So if you want to invest in a REIT, but your concern is on the fluctuation of interest rates, what you can do is that, number one, you choose a rate that has lower in terms of its gearing ratio. And number two, you choose a rate that has more fixed rate debt than floating rate debt. Okay? Now, here's another example of solid REIT, not so solid REIT. Solid REIT versus weak REIT. Now, this is actually for a REIT. Can you see that this is actually 50%? So this is actually the maximum that is set by Securities Commission in terms of the maximum gearing ratio that a REIT can actually have in Malaysia. So this is actually maximum 50%. So for a REIT, what we can see is that the gearing ratio is well below 40%, in fact, well below 30%. So it's actually at around 20+%. So as you can see, this is actually of a good buffer before it actually hit the maximum. All right, so it will be less impacted by other REITs which have higher gearing ratio. And over here, we can see that what I gather for a REIT is that 100% of this debt is actually based on fixed rate. So which means Bank Negara Malaysia can say, oh, OPR rate goes up. It doesn't really impact too much on a REIT because their debts are on fixed rate, not floating. Okay. So as you can see, not much of impact when it comes to interest rate hikes because fixed rate debt, all right? So no impact or very minimum impact. Now let's take a look at a fundamentally poor REIT, which is B REIT. This is the maximum, which is 50%. So over here, what happened is that the REIT has well above 40% in terms of gearing ratio. So which means they have more proportion of, they have more debt as their debt to asset is actually higher than the one that is fundamentally solid, which is not too good. Okay, so over here, we can also see that for B REIT, most of this debt, they are on floating rate. 80% of it is actually floating rate. 20% is actually on fixed rate. So which means to say, if let's say Bank Negara decides to increase the OPR rate, then of course this REIT will be more impacted because 80% of its debt is actually on floating rate than on fixed rate. So this will be more severely impacted. Of course, the stock price actually reflects everything, all right? And therefore, but this kind of stock price is actually a reflection of not just interest rate hikes. It's not just one thing, but more importantly for this REIT is actually, it's just poor in terms of its fundamental quality. It just, like just now what we see, the income productivity, the sales, the rental income, the net property income, the distributable income is all quite weak. It has been declining for so many years. Therefore, the stock price actually looks something like that. Okay, so so this one is actually a combination of many factors. So this one is something that you can actually avoid. All right, so we have actually covered part one. Now let's move on to part number two, where I'm going to just show how does REITs actually use leverage to grow its property portfolio. Okay, so now I will go a little bit slow, so pay attention, yeah. Let's do a case study. Okay, so this is actually a REIT. So let's say we have a balance sheet, yeah. So this is actually the asset of the REIT, let's say 100 million. Let's say the current debt is actually 20 million. So technically speaking, for this REIT, if you want to calculate the gearing ratio, we take the debt, which is 20 billion, divided by 100 million, which is the total asset value. Therefore, the gearing ratio is 20%. But for Securities Commission, all right, the maximum that a that a REIT in Malaysia can have when it comes to gearing ratio is 50%. All right, 50% of 100 million. So which means to say, technically speaking, they can actually borrow. They have a debt buffer. They can still borrow. How much? How much? So this is 50 million minus of 20. They still can borrow another 30 million. So what they can borrow for? This 30 billion, they can actually use it for two main purposes. Number one, it is to do asset enhancement initiatives. All right, in layman's terms, this one is actually considered as renovation and refurbishment. Okay, asset enhancement initiatives. Number two, this is actually the more important one, which is to buy new properties. So you want a REIT that has lower gearing ratio. All right, and the reason is simply because of this debt buffer. The lower the gearing ratio of a REIT, which means to say the REIT has financial capability, they still can actually use their debt buffer to actually buy new properties if they choose to do so. But if let's say you have a REIT that is about to hit maximum 50%, which means to say it's kind of like someone, how I say, it's kind of like someone who wants to buy a piece of property.
Ian, I think Ian just dropped off the line. I think let's give him a minute until he get back up. Okay, now he's back. Ian,
Whoop.
Your line just cut off.
All right, so
okay, apologies
sorry
for
for
the
that glitch, and let's continue. Oh, it just happened just like that. All right, so okay, so let me just repeat myself about this, and then we can just continue ahead. All right, so this is actually it's like our calculation for debt service ratio on the personal level. So it's like for example, if let's say you are earning a salary of 10,000 ringgit a month, then maybe the bank allows a debt service ratio of 60%, which means to say you can borrow from the bank, the debt installment that you're going to pay to the bank at maximum is about 6,000 ringgit every single month. Okay, so if let's say the person, the 10,000 ringgit earner, has a debt commitment of let's say 1,000 ringgit, then obviously it has a huge buffer for him to actually use to tap into purchasing, to actually borrow from the bank to actually buy investment properties. But if let's say this guy, 6,000 is the maximum because he's earning 10, he already borrowed up to 5,000 already, then it's a bit hard for him to continue to borrow from the bank to actually buy investment properties lah. So that is actually, debt service ratio on the personal level. But for the REIT, this is actually how we calculate. This is actually the same thing that we see for a REIT. Okay. Now, what does knowing this have to do with the growth of a REIT? Okay, so pay attention. Now, it is actually very important for the REIT, all right, the properties that they have to appreciate in value. So let's say, for example, we have the assets here, and then it appreciates by, let's say, 60 million. So 100 million, it now appreciates to 60 million. And because of the Securities Commission requirement, where the maximum REIT is actually 50%, so if the property portfolio here actually increase or appreciate by 60 million, which makes the total asset value now become 160 million. So the amount of debt that they can actually get is actually now 80 million. From 50 million, now it's now 80 million. And let's say, for example, this REIT continues to have 20 million in terms of debt. Therefore, the debt buffer now increases from 30 million to 60 million. Can you see that? If you cannot, just put in the chat box, say, either you say you can, or if you cannot see, then you just type in the Q&A box. Later, I will address your question. Okay. So can you see that the appreciation in the properties that the REIT own can actually increase the debt buffer? And this debt buffer, once it increases, it allows the REIT to borrow from the bank to actually do more asset enhancement initiatives, and as well as to pursue acquisition of investment properties in the market. The more debt buffer, the more choices of properties that they can actually purchase. All right. So what you want here as a REIT investor is, number one, you want a REIT that has lower in terms of gearing ratio. And number two, you want to have a REIT that has quality properties that can appreciate over time. The more it appreciate, the more debt buffer it can actually get to actually fund all these growth initiatives. So that is actually how why it is so important for REIT investors to always focus on the fundamentals of a REIT. The better the fundamentals, the more chance it can actually do that. And that is actually how a REIT can grow its portfolio over time. Now, on the flip side, let's say, for example, you happen to choose a REIT. Let's say this is actually the REIT. And the thing is that the REIT has poor properties. It has a poor portfolio that consists of properties that depreciate in value. From 100 million, now it's down to 80 million because of the property depreciation, capital loss. Now, because of that, the debt buffer will also shrink altogether. So initially we have 50 million. Now because of the depreciation of 20 million in terms of property value, the debt buffer will also shrink by another 10 million. Okay, so if let's say the debt buffer shrinks, therefore it has lesser options when it comes to financing for asset enhancement initiatives, and as well as to pursue any sort of a meaningful acquisition of investment properties. Okay, so you may not want that as a REIT investor. Okay, so typically when it comes to gearing ratio, just remember this. Low gearing ratio is more preferred than higher gearing ratio because of the debt buffer. Number two, you want the properties to appreciate over the long term over properties that depreciate over the long term. Okay, so you want properties to appreciate, not depreciate. Okay, so that is actually part number two. Now, part number three, we are going to talk about calculation of net distribution per unit of a REIT. Okay, so this is actually where the calculator comes in very handy. So with that, let's do a demonstration. There's no like, how I say, software, any website, any portal that is going to help you calculate this. This one, you can only do this manually. So I'm going to just demonstrate to you right now so that you can actually do this on your own. All right, so I need some volunteers over here. The thing is that the first person who is going to name me a Malaysian REIT, I'm going to use that REIT as a basis to actually calculate the net distribution per unit of that REIT. Okay, fine. The first one to put in is actually Eugene Wong. So Eugene Wong, thank you so much. You put in PAVE REIT, so it's Pavilion. Okay, let's do Pavilion REIT for today. All right. Now I'm going to just open up a brand new spreadsheet like this. Let's just make this bigger so that everyone can see. 1 second. All right, everyone can see. So let's do this let's just calculate the net distribution per unit for Pavilion REIT. So the thing is, we're going to just put in Pavilion REIT. And over here, we are going to go to, let's say, entitlements. Okay. So in order to calculate the income distribution, in order to calculate the net distribution per unit, so we need 1, 2, 3, 4, because the latest 12 months, because typically for a REIT, it depends on what REIT lah. But for Pavilion REIT, it seems to me that it has been paying out net distribution per it has been paying out distribution on a quarterly basis. So therefore, we take the latest 4, 1, 2, 3, and 4. Okay, the latest 4. So let's start off with the first one. Okay. So it says here interim income distribution, 0.76 cents per unit. And it comprises of two things. Number one, taxable. Number two, non-taxable. The taxable one is 0.3. The non-taxable one is 0.03 cent per unit. Okay, so here I'm going to just put in period. So let's say 1, 2, 3, 4. So the latest one is actually the 4th period. So let's just make this okay. So we're going to just put in taxable and non-taxable. Okay. So the final period is actually this 0.73 cents per unit and 0.03 cents. Okay. The non-taxable one, you will receive it in full. The taxable one, you will actually, there is a 10% withholding tax on it. Okay. So we are just going to compile this data, and then shortly I'm going to demonstrate how you can calculate the net distribution yield. Now let's move on to the next one, which is this. Okay, so you can see that the interim income distribution is right over here. It's 3.65 cents, whereby the taxable is 3.53. The non-taxable is 0.12. Okay, so 3.53, 0.12, which is followed by the next one, which is this. Okay, so we have the final income distribution, 4.29, whereby taxable is 4.16, non-taxable is 0.13. Okay. All right, so now you see here, after 3 periods, this one seems to be like, this is like 4.29, this is 3.65, but then here is like 0.76. So since I see that there is, why this figure is so low, so I have to look at, my hunch tells me that I should be looking at the periods. Why is it that way? Okay, so this for the financial year end 31st December 2023. This one is financial year end December 2023. Okay, this one is for 31st December 2022. Okay, now let me just double check on this. So this is actually for December 2022. So this is interim. This is final. This is interim. This is still interim. Okay, what Jocelyn said is actually correct. From here I can see that, okay, the mistake that I have actually just spoken is Pavilion REIT actually pays distribution typically usually twice a year, all right, and not on a quarterly basis. So the thing is that, so for this, after I look at this, I will not actually include this in the calculation of the net distribution per unit for this. I'm just going to focus on these 3, 1, 2, and 3, because this will be more accurate. This is actually accurate, as Pavilion REIT pays out distribution twice on annual basis, not 4 times, 2 times. Okay. So with that, let's just move this upwards. I believe these periods are actually joined. Now this would look more accurate. Okay. So with that, let's calculate the taxable portion, which is 8.42. And then we have the non-taxable, which is 0.28. So this one, you get it in full. So you're obviously going to get 0.28. No problem. For the taxable one, there's a withholding tax of 10%. So what you need to do is we have to take C6 and then we have to multiply with 90% because we have to reduce or we have to deduct 10% withholding tax away from the taxable portion of the DPU. So therefore, the taxable portion is 7.578. And then, so this is actually what you'll be receiving plus this. So therefore, the net distribution U would be 7.585. Okay, so this is actually the net distribution per unit for Pavilion REIT as demonstrated with this slide. Now, CK Chia, the thing is that what is taxable and what is not? Good question. So taxable typically is like, let's say, for example, rental income. So rental income is obviously taxable. So this will actually be here. Anything that is actually related to the operations of the REIT will usually fall under taxable. Now, for non-taxable, let me give you an example. Let's say, for example, a REIT actually disposes one of its investment property from its portfolio, and from it realizes some capital gains. And typically, these capital gains, they can actually keep it in full, or they can actually distribute it. And when they distribute it, one of it can be under non-taxable. Okay, so Emily, you thought that REIT doesn't pay dividends? Not too true, huh? Okay, so the REIT will, so if they distribute the DPU to unit holders, so it depends on what rate. Corporate investors is different, but for here, since I believe most of us here are individual investors in Malaysia, our rate is 10% of the taxable portion. So that is actually the rate for us. And typically we don't need to worry about, oh, do we need to file this on LHDN or what? I'm not a tax advisor, but I would say that what you get is net of tax. Okay, what we get is net of tax, not the gross. We get the net of tax. The 10% withholding tax, the REIT will help us pay. Okay, they will help us pay. After they pay already, then the net will be credited into our bank account. So that is actually how it works. Okay. Now, any questions, just put it in the Q&A box. With that, I'm going to just go on to the slideshow. And now the final part, which is part number 4, where we are going to address the 2 key metrics to assess the valuation of a REIT. So the 2 metrics is this, distribution yield and PB ratio. Okay, so these are the 2 very simple valuation ratio, but here I'm going to just show you the art of how I would use it, okay, if I'm a REIT investor. So the first one is distribution yield. So typically what I do is this. I will calculate the net distribution per unit. I'll calculate the net distribution per unit, all right, for the past 5 years, for the past 10 years, like this, okay? So in this case, this is actually 10 years. So you go all the way up to 10 years. Then I will find the closing stock price of the REIT. What do you mean by closing stock price? So let's say, for example, let's say for a certain REIT, it has a financial year end at 31st December. So the closing stock price will be, for 2022, will be the stock price at 31st December 2022. So as for 2021 is 31st December 2021. For 2014, it will be 31st December 2014. From there, I will actually calculate the net distribution yields, which is calculated as followed. So let's say, for example, we have 2022. So we take the net DPU over here. We divide it by the closing stock price, and thus we will get the net distribution yields past 5 to 10 years. And subsequently, we can actually plot a graph like this. All right, so this is actually the net distribution yield for the past 10 years. Now pay attention, okay? So this is actually the art of valuation. For distribution yield, can you see that there's most of it is actually in light blue, except for the orange one. So the orange one, why is it orange? Is simply because this is to actually highlight these are the distribution yields that the unit holder is actually getting during COVID-19. So because it's actually at a time where it is not normal, so I tend to actually remove it from the equation. Because when it comes to valuing certain things, valuing a stock or valuing a stock or valuing a REIT, we want to actually value it based on its actual ability to deliver profits, actual ability to deliver dividends. So therefore, we will actually remove this abnormally, and we just focus on the ones that are more reflective of the normal business condition. So based on the normal business condition, we find that the lowest distribution yield is 4.37%, average is 5.04%, and the highest is 5.51%. So what it means here is that as a REIT investor, I will obviously aim to actually get the REIT when it is trading at the price that can offer at the highest possible dividend yield, which is 5.51%. I would say 5% for this REIT is actually quite fair. Of course, if let's say it's offering at 4.4%, then I would say it is kind of like overpriced or overvalued. So that is actually how I will look into distribution yields. Okay, so that is actually for distribution yields. Now let's go on to PB ratio. So CS Wang is actually asking, how do you actually get the closing stock price? All right, so let me just repeat again. Let's say, for example, a stock, the financial year end of the stock is actually 31st December. Let's say it closes its annual accounts at 31st December. So the closing stock price refers to the stock price at the time when it closes the financial accounts, which is 31st December. Okay, so you get the closing stock price as of 31st December. If it's 2022, you get it at 31st December 2022. If you want to get the closing stock price for 2021, then you get it at 31st December 2021. Now, where do you get it? You can get it from either from Bursa Malaysia website, or you can get it from Google Finance or Yahoo Finance, okay, whichever is more convenient for you. So that is actually how we get closing stock price. Now, for net asset value, what we do is that we just copy and paste. From there, we can get the PB ratio. Okay, so PB ratio is calculated as follows, which is price divided by book value. So book value is the same meaning as net asset value per unit, okay, for REITs. So what happened is that we can take, let's say for 2022, the closing stock price is 1.65. We just divide it by 1.08, and then therefore you get a PB ratio of 1.53. So you do the same thing for the past 10 years, and then you are able to generate a graph as followed. So this is actually how the PB ratio looks like. Now over here, what we can do is that there are two ways of doing it. The first one is that, can you see that this tree over here, the PB ratio is actually quite low. So as a REIT investor, what I can do is that I can just include the lowest, the average, and the highest over here. Then I will just value it based on this, avoid this tree. That's one way of doing it. But if you want to include the 10 years, also can, but you will get a lower average. So in this case, for these figures, it is actually inclusive of the 10 years figures over here. So what we can see is that the lowest is obviously here, which is 1.136. The highest is 1.766, and the average is about 1.49. So what does it mean? It means to say that if you can get this REIT at a PB ratio of below 1.5, it is usually pretty good, which means to say it's pretty undervalued. But if you are getting this REIT at a PB ratio of 1.6, 1.7, 1.8, then it could be more and more overvalued. Okay, so don't get it at a PB ratio which is higher than its average. Okay, so with that, I have actually covered my my materials when it comes to the the 5 pointers when it comes to becoming a good REIT. So that's it, guys. And I'll hand back the control to Shane, where we are going to address all the questions asked by our audience.
Thank you so much, Ian, for the wonderful session on REIT. So now we know how do we go about assessing REIT, whether they are fundamentally strong or whether they are fundamentally weak. If you have any questions to ask our speaker, Ian, you may write them at the Q&A box. We'll address them in a short while. Okay, don't write that in the chat box here because the messages are just so many. I may overlook your message, okay? So the first question is, how do we know the occupancy rate? Is it reflected in the annual report?
Oh, of course. So let's look at Pavilion REIT lah. Then from there, we can actually see whether or not is it reflected or not. Okay, so all you need to do is just go to company announcements since okay, forget about all this. All right, so we are at Pavilion REIT. All you need to do is just go up to annual report. So this is actually the latest annual report. Let's say it's 2022. So you just click onto that. All right. Usually the occupancy rate will be reported at the part 1 lah. Part 2 is usually all the financial stuff. So part 1 lah. So let's go down for Pavilion REIT. Okay, it's been a while. I last read this annual report. So that's why bloopers just now. It's not quarterly distribution. It's half yearly. All right. So blooper here. Okay. So now you can see the portfolio performance and its details. So let's say, for example, you want to find out about Pavilion Kuala Lumpur. Okay. So they will give you the description of the property, how many car park, what's the acquisition price, what is the current value. So usually you buy a property at 3.2 million, appraised value is 5 billion. Usually that's a good sign. And here it is. There you go. Occupancy rate as of 31st December 2022, 91.6%. Then that is actually how you do the comparison. No? All right. Then you can actually move on to the next shopping mall. Here it says 86.9%. Then you have to actually see whether this is actually a good sign or a bad sign. So usually, how do we know? We actually compare it with the past. But because this is a shopping mall, you can always take a drive, go to Intermart Mall and see for yourself whether or not is it a very well followed mall with a lot of footfall, or whether or not there are empty lots at Intermart Mall. Yeah, so this is actually how you look at occupancy rate from the annual report. All right, Shane?
Thank you so much, Ian. The next question is asked by Eugene. There are quite a number of investors who dislike REITs, especially for young investors. They argue that they should focus on stocks with growth that also pays dividend over the long term. So what is your view on this?
Okay, so the key thing here is young people, all right? So addressing the young crowd. So number one is that it depends on what is. So what do you mean by, there's two schools of thought to this. The first one is that, let's say you are completely a newbie. You're completely a newbie and then you just want to it's your first time buying a stock. So what happened is that if let's say I would say I can't say for all, but for myself as last time when I was in my 20s, I started off with dividend investing. Why? Simply because although I mean to say it's about testing your strategies, because your portfolio is not big, you can test it out. All right, you build a watch list and then you start off with some dividend stocks, including some REITs, and then from there you get your first few distribution and many more distribution. Actually, although it's not much, all right, at that time, the REIT, maybe some REITs actually they pay you a little bit of distribution. Maybe the amount is good enough to actually buy you a meal, for example. Okay, very humble beginnings, but then it's okay. It keeps you going. It keeps you at least you're actually getting certain kind of results that motivate you to actually continue investing. All right, so that is actually my way of actually building my portfolio lah. All right, so that is actually one school of thought. But the other school of thought is that they look down on that they look down on the dividends. So it's like if let's say today you ask people to actually invest in dividends and then they are only getting 3, 4, 5% per annum, and they say that is too slow, they want something faster. That one is another way of thinking lah. But I would say that those kind of stuff, right, will be best applied when you know what you are doing lah, which is after several years of experience of investing, then you can actually pursue that kind of stuff. But if you're a newbie, you just say, I want to make fast money in the stock market, then number one is the fastest way to lose money in the stock market. Number two is also the fastest way to lose the motivation to actually continue on investing in the stock market. So not too bright lah. So it really depends on whether or not you should go pursue growth, because pursue growth can mean very different things to a lot of people. If you want fast money, the best thing is don't invest lah. If you want to build your portfolio slowly, you can consider dividend investing, or you can do dividend growth investing. Right, Shane?
Thank you so much, Ian, for answering the question. The next question is, do you have any benchmark for the price to book value ratio? Like above what level is considered not very good, and below what level is considered good?
For PB ratio, the thing is that we compare it with the past. So it's all relative. So there's no real like, oh, 1.5 is bad, or 1.5 is bad, below 1 is good. I didn't actually have that kind of stuff.
All right, so you compare to the historical PB ratio, like right now they are trading at below the average of the 10 years. So you may consider this as a good, attractive price. Am I right?
Yep, you can say that.
Okay, so the next question is, which REIT is better? Is it S-REIT, Singapore REIT, or is it a M-REIT, Malaysian REIT?
There's no better or not better lah. Okay, it actually depends on the of course, Malaysian REIT is actually a good starting point. I mean, it really depends on your own circumstances lah. That's why investing is so personal in certain ways. So let's say, for example, you are asking, let's say a newbie investor who is actually just whose capital is actually limited. Okay, limited capital. Then I will say that Malaysian REITs is a good starting point lah. Okay, it's a good starting point to actually get started in investing because it's more affordable. Not necessarily cheaper, not necessarily better, but it is more affordable. As compared to S-REIT, I mean to say the thing is that of course there are benefits to S-REITs. It's a bigger market out there, right? And then it allows you to hedge against the depreciation of ringgit against the Sing dollar and all this kind of stuff. But then the capital requirements to actually invest in S-REITs will be significantly higher. So again, if you have the capital and you can actually, I would say that you can actually explore Singapore because it's already a known fact that it has a huge and a more matured, more developed REIT market. However, if you are just starting off, you can always start off with something which is closer to home and you are more familiar with which is Malaysian REIT. It's okay to own both. No problem. The fundamentals is actually more important, regardless of which market you go into.
Okay, I love your answer, Ian. The next question is from Maddie. Do we need to take into consideration management expense ratio?
To make your life easy, no need.
Okay, straightforward answer. Okay, Janice would like to ask the next question. What is the regulation on the property revaluation? Is it mandatory every year?
I believe that since REITs have to actually come up with their annual reports on a yearly basis, so therefore there will be revaluing their properties in their portfolio on a yearly basis lah. So I guess yes lor. So there is a requirement to revalue their properties lah.
All right.
Ah.
Next question is by Chen Fugan. If the REIT distribute rights or bonus, there will be a big difference in the closing price. So do we just calculate normally for the PB ratio, or do we need to divide based on the rights or bonus given before the calculation?
Okay, so rights and bonus, it depends. Like, let's say if it's bonus, so it's like, okay, the net asset, so let's say the stock price is 2 ringgit, and then 2 ringgit net asset value is 2 ringgit or so, so your PB ratio is 1, right? Now it says bonus ratio, bonus issue, okay? Your $2 become $1, okay? Because bonus ma, all right? So you're, so from $2 it become $1, but then you have double the amount of shares. The net asset value will be adjusted from $2 also down to $1. So therefore, a PB ratio is still the same at $1. So usually, for bonus issue, it doesn't impact that much when it comes to valuation. You just need to know how to do the adjustments. Then it should be as straightforward. But rights issue is not exactly super straightforward, because rights issue, it really depends. It's very subjective, because some people actually, some REITs may use rights issue to raise money. Remember this gearing ratio thing that we talk about? Okay, this gearing ratio. So if let's say you have a REIT that has a high gearing ratio, like almost hitting 50%, and then it requires some capital to actually either fund a new property purchase or just to reduce their debt, and therefore they do the rights issue, then of course it depends on the situational case lah. Then you have to adjust accordingly lah. But if a REIT requires rights issue to do that, usually that is not very preferred lah for REIT investor.
All right. In fact, we have one comment by Van in the chat box that says that in reality, buying REIT for dividend is not an easy exercise. For example, Axis REIT has been issuing rights to identify investors to raise capital for asset acquisition, thereby diluting minority shareholder stakes and asset value per unit. So how do you mitigate this?
It depends on how often, how frequent that REIT actually, because Malaysia, I mean, the amount of REITs, not too much also lah, all right? It's just 18 REITs lah. So if let's say you're not too comfortable with Axis REITs doing that, then of course you can just avoid doing that lor. That is actually one way of mitigating the risk altogether lah. Just don't buy the REIT lah. That is actually, that's probably the only choice lah. Or you have or if you like the REIT, because the fundamentals of, let's say, Axis REIT is actually quite okay, you just don't like it to keep on issuing rights issue all the time, then you can always have a smaller position in Axis REIT lah, just to keep maybe a few percentage inside your portfolio lah. That is actually all you can, that is all I think you can do lah. If let's say issuing rights is actually an issue, either you minimize your position or you just don't have it altogether lah. But not a buy sell advice lah. It's just of course we don't do that here. It's just more of a preference thing lah. But since for rent is actually something that is of concern, then you can choose accordingly lah, based on your preference lah.
I think whether we like it or not, these are the REIT strategy. Most REITs carry out this kind of exercise. This is their SOP when they do revaluation on the properties, and when there's appreciation in the property prices, then they have a bigger debt buffer, like what Ian coined it, right? So when they have a debt buffer, they will do rights issue or they will do private placement to raise cash to acquire new property. This is as part of their expansion strategy to have more properties into their portfolio. So I guess this is how REITs grow their portfolio and declare more income to the investors who invest in them, and by using cash calls such as private placement and rights issue to acquire more assets into quality asset into the portfolio. Yeah.
Yes.
The next question is by Stephanie. Her question is: with the increase in the building material price, property price would go up in the future. So does it mean that the properties in REIT will be higher?
Of course, I won't count. I mean to say, yes, building materials will go up. So that is also a rationale of why properties will go up. But then I won't bank on it if I'm a REIT investor lah. Actually, what's more important as a REIT investor is not, you don't invest because of that lah. You invest because of the income productivity lah, which means to say how much, whether or not the properties that they have in the portfolio, are they of good standing in terms of their fundamentals, their location, whether or not they are good, whether or not they have high demand in terms of tenants, whether or not they can actually generate increasing growth in rental income. These are the main stuff. These are the major stuff that you need to look at as a REIT investor. Because building materials go up, but then there are REITs who are not performing as good in terms of their fundamentals, then no point also lah.
So when you evaluate REITs, it is also important to look at the quality aspect of it, which is like the quality of the asset. The next question by Tony Leong is that, are there any REITs that are linked to ESG at the moment and the future?
Yeah. Wow, I didn't actually look into this lah. Of course, I mean to say for Malaysia, more actually the is whether or not the REIT is actually is it Sharia compliant or not Sharia compliant lah. That kind of stuff I think I will go to a place to actually filter lah. From there, you can tell whether or not you have to do the annual report lah. But then for me, it's not really that case lah. I didn't actually look into that particular part when investing in a REIT, so couldn't answer that lah.
All right. So the next question is by Maslan. When is the best time to buy REIT? Do you think it's better to buy before the distribution or after the distribution? That's his question.
I mean to say it makes no difference. Number one, the fundamentals is still the ultimate deciding factor. Okay. And the thing is that actually I don't really, because we are holding on to it for the long term, so usually we don't really care too much lah. You can always buy it before, but then if you buy it after, it doesn't hurt you that much also lah. So I guess, but of course, if you buy it before, you get a chance to actually, okay lah, you can test out lah. You can test out whether or not you can like you can experience for yourself whether or not the REIT will pay you dividends lah. I mean to say, usually it will lah. Okay, but if you just want to have your first distribution pay out to you as an investor, then just buy before lor. Just buy before, just wait for 1 month, and then I received my first distribution. So if you just want to test it out, then you can buy before lah. But if you are holding on to it for the long term, no need lah. Okay, you can just buy. Don't worry too much about that minor stuff lah.
All right. The next question is by Maddie. Is there a way to calculate intrinsic value of a REIT? What do you think?
Usually we'll go with the net asset value of a REIT lah, because we are not too concerned about no, we don't actually calculate interest. Usually for REIT investor, we don't calculate intrinsic value of a REIT, because the property valuation is done by so that would be our basis of valuation. So as a REIT investor, we rely heavily on the calculation that, or the valuation that has been done by professional valuers. and they come out with their own report, and then they report to you what exactly is the valuation, the latest valuation of the property. So with that done, then there's no real need to actually really calculate the intrinsic value of a REIT.
All right. Jocelyn would like to ask, do you look at account receivable and concentration risk, like a few tenants, when you are evaluating REIT?
Accounts receivable, number one, for REITs, usually when you look at the annual reports, the accounts receivable are not too much. All right. Usually I mean to say the chances of having bad debts are, not to say don't have, got, but a bit low, simply because people pay rental in cash. It's not like a credit business or whatsoever. Okay. So typically cash flow wise for most REITs are actually quite there one. All right. So accounts receivable is actually not a major factor. Concentration risk, which means just a few tenants or just a few properties or just in a few selected markets, then you may actually look into that, and that will actually impact how you want to do portfolio. I wouldn't say that were properties is that and you okay, because sheer size in terms of its and the number of okay of my capital to
Ian, your voice has been breaking up. Hello, Ian, can you hear me? Okay, it looks like he has dropped off the line. Okay, he's back up. Ian, can you hear me? I think your internet connectivity is not that stable today.
went off again.
Yeah,
Right,
your
Shane?
voice is still breaking up. Right. Can you hear me?
I mean, that.
All right. Ian, your internet connectivity is still not doing very well. So we have come to the end of this, almost come to the end of this session. Maybe you want to give a concluding remarks to end the Q&A.
Sure. Okay, so let me try. So when it comes to REIT, it's like investing in stocks. You just need to focus on the fundamentals. Just be more long-term focused, long-term minded, and do your valuation. Just try not to overpay, and you should do actually quite fine. All right. When it comes to Wi-Fi connectivity, sorry, next time maybe back to you, Shane. That's about it for.
Thank you so much, Ian.
Yeah, that's my
Apologies for the
last
technical glitch from Ian for the internet connectivity issue. All right. So ladies and gentlemen, you just heard from the co-founder of Dividend Vault, which is Mr. Ian Tai. Thank you so much, Ian, for sharing with us how do we pick fundamentally solid REITs. All right.